This conference will now be recorded.
Oh, it was not started. Okay. So I request every members over here to participate, ask more questions, discuss more with respect to the new regulation for the NBFC. Yeah, Sebastian, over to you, sir.
Yeah, thank you very much, Bhavin, and thanks, Nitin, for that kind introduction. I'll begin, with this discussion. I was told, to keep it as interactive as possible. Nevertheless, despite that, I decided to put a presentation here, so that there is a structure to the flow of our discussion. But in case you'll have any views or, just have any queries, any kind of clarifications required, please don't hesitate, to stop the discussion there and, just ask me. I'll just begin off with a normal disclaimer, that these are all my views, and neither ICI, the institute, the WRC, nor the organization where I'm employed should be held liable, for any statements made by me. Just to give you all a small brief on how the flow of this discussion will go, I just thought I'll just touch upon the need why there is this need for increasing governance in NBFCs. I'll then go on to give you all a summary of the guidelines on the risk-based internal audit, where I'll touch upon 3 points. One is the role of the audit committee of the board, the role of the senior management, and the internal audit function. I'll even take some time out to touch upon a little on the RBI policy and the RBI plan. And one very critical part is the risk audit metrics, which I'll take a little extra time here to express this as detailed as possible. Actually, this is the crux of any risk-based internal audit plan. We need to get this the risk assessment metrics or the risk audit metrics very clear. So the clarity there is very critical on how we draw up our plans and how we go ahead with the efficacy of this RBIA. And lastly, I'll just discuss certain responsibilities and expectations which have been elucidated in this guideline. I just put it in 2 slides. I'll take you all through that as well. Beginning with the first point, which we were discussing about, need for increased governance in NBFCs. As you all understand, the NBFCs when they started off, just more as a shadow banking unit, where the idea basically was to support the banking system. There was a strict need felt that there are certain segments or certain set of customers, mainly from tier 2, 3 cities, or certain customers from the unorganized segments in urban cities also, which are not getting catered by the banking, uh, proper formal banking channel. So that's why the need was felt, to have NBFCs which will work on providing very specialized products. So if you see, a lot of these NBFCs are monoline, they deal in monoline products, and they target very, very, very specified segments. So the amount of specialization, the amount of customer personalization is very high, in NBFCs as compared to banks. Not only that, considering the various challenges that NBFCs faces, that they have started leveraging technology in a very big way now. And in addition to that, there is a lot of collaboration that at the moment, happens between fintechs and NBFCs. So considering all of this, and coupled with the fact, that the NBFC, that the contribution of NBFCs to the overall GDP is growing by the every passing day. Earlier, when we just started off, the NBFCs would have hardly been contributing to about 6 to 8% of the overall GDP. But today, the credit penetration of NBFCs touches almost 12%. In fact, what is more, heartening to see is that the growth rate at which banks and what NBFCs are growing in terms of credit penetration is, there is a lot of divergence between them. So if you see, NBFCs are growing at almost 32% annually, as compared to banks, which are growing around 10 to 12%. Of course, this is changing a little, with the onset of COVID. We had, moratorium, restructuring happening, and, the NBFC books have got a little hit with this. But nevertheless, this growth rate has, actually kind of alarmed the RBI. In fact, much before COVID, we had the ILFS and the DHFL aftermath, which saw the RBI and other regulators feeling the need that there is a need to regulate the NBFCs more. That's how they came up with the CRO framework. They came up with this guidelines somewhere in May. You then had the liquidity risk management framework, which came somewhere in November 2019. That was followed by certain guidelines for a risk-based scalar approach for regulating NBFCs, where they divided NBFCs into four parts: the base layer, the middle layer, the upper layer, and the top layer. So, of course, those are still guidelines which have to come into picture, but we are sure that this will happen. There are certain drafts which are out, and there is some kind of deliberation happening on all of this. And lastly, the most recent major notification being this one, this risk-based internal audit notification. So here there have been, there's been, another great attempt made by RBI, to get the NBFCs, the large NBFCs, that is. So generally, this has been uh, the current guideline has been designed in such a way that it covers all the deposit taking NBFCs and all the non-deposit taking NBFCs which are over 5,000 crores and above. So so this is how this thing has been put up in very much in lines of scalar based approach. Just move on to the next slide. So the whole idea of this is, with the growing, with the with the rate at which NBFCs are growing, there is a very urgent need for suddenly to put some kind of regulations to monitor this, just to ensure that the financial stability in the markets is maintained. Uh, what I have done is I have just summarized these guidelines. If you see, I've put the applicability, the timeline within which it has to be achieved, what is the transition plan here, the objectives, and I've touched upon the segregation between both risk management and risk-based internal audit. I already touched upon the applicability. The guideline is expected, the RBI expects us to implement this framework by March 31st, 2022. And of course, the board, though, is overall responsible for the oversight of implementing a risk-based internal audit system. But it all depends on I mean, there is a plan given here. We have already formed a committee of senior executives to help enable this entire change management, to overlook the entire transition process, to manage whatever. In terms of adequately filling up the resources and all for this team. And not only that, there is a quarterly update that needs to be given to the board and management on this. In terms of the objective, earlier, of course, when we used to do internal audit, it was restricted more to giving an assurance on the overall controls and the efficacy of financial statements and all. The risk-based internal audit is just different in terms of the methodology. Here, the entire base is your risk management framework. On the base of your risk management framework, the internal audit is expected to, apply the audit procedures and comment on both the quality and effectiveness of these controls, on the risk management framework and the governance process overall. Of course, it doesn't mean that we do away with the selective transaction testing and all of that. That all will remain, but the scope has got a little widened in terms of there's a need first that there's a risk management framework which is set in the organization, basis which there will be areas of operations which should be identified as high risk, medium risk, low risk. We'll of course touch upon these concepts a little later in this presentation, but basis these categorizations, there would be different audit, the audit plans would be prioritized, and depending on it, the various audit procedures would be applied. One, I'll of course not take this point up since it is covered in the next slide, where I've detailed out the risk management and the risk-based internal audit. It's very easy, like sometimes both these concepts, tend to get used quite
Not audible.
Sebastian, we cannot hear you.
Ah,
We cannot hear you.
Hello, we cannot hear
risk,
you.
on what controls can be done. Sorry.
We
Yeah,
cannot
now
hear
we're
you.
able to hear you.
Oh, I'm so sorry. You can
Can
hear
you
me now?
repeat the last? Can you
Okay.
repeat the last between this
Yeah,
slide?
yeah. Sorry. This slide. I begin with this slide, you say?
Yeah, yeah.
Okay, fine. Yeah. So, it's very common, in most organizations, most corporates, risk management and risk-based internal audit is considered as, two synonymous teams or, concepts, but there's a remarked difference between the two. This is part, the risk management team is part of the second line of defense, whereas the internal audit, and even if we use the risk-based internal audit, it is part of the third line of defense. Risk management, would broadly comprise of, identifying, measuring, monitoring, and managing risks. Whereas the risk-based internal audit will be more of, basing their audit program around the evaluation of, the risk management framework, and basis that, prioritizing their plan and, determining the flow in which they would conduct the various audit procedures, depending on the inherent risks there. If you see, risk management is responsible more for advising the businesses, on the various risks, on the controls that are in place, whether the controls are adequate, not adequate, and following up with this. Whereas the risk-based internal audit, of course, in addition to that, their most important objective is that they need to give the board an assurance, that the risk management processes and they're working effectively, they're in place, and it's all in line with the overall risk appetite that has been set by the board. So if you see, risk management will involve forming, crafting risk policies, coming up with these risk procedures, even working out on certain risk management models, so the entire aspect of identifying, then measuring or quantifying the risks, then monitoring risks, will lie in this department. Whereas the risk-based internal audit will be more responsible for um, evaluating and assessing this effectiveness of this framework and monitoring these risks. Yeah, any questions? Maybe I'll move ahead then. Yeah.
I think Taruna, can you mute yourself? Taruna, can you mute yourself? Okay. Yes, sir. You can.
Great. Yeah, no problem. Yeah. So, yeah, in the next point, where we are, going to cover the role of the audit committee and the board, that is, of course, with respect to the RBI guidelines only. There are a lot of other responsibilities that they are, involved in, but the most important responsibilities from the point of view of an RBI is one, they'll be responsible for overseeing the entire internal audit function, and also reviewing the performance of RBI annually. So this is like the main most important thing. They're expected, to both formulate a quality assurance and an improvement program where, they would check the effectiveness of the internal audit program. They would see whether, the various audits, various objectives that have been framed, of this RBI, whether that has been achieved, or whether the follow-ups have been proper, whether they have managed the overall control program, and the evaluation of the risk management framework is in place. And another very important thing which has been put in is promoting the use of new audit tools, new technologies, and the whole idea of doing this is to reduce the extent of manual monitoring that we do, the transaction testing that we do, and the manual compliances that we keep monitoring on Excel sheets. So the onus of introducing the technology has been put on the audit committee and on the board. So this is one thing that in case we are part of the inter audit function, this is something that will always be a very important deliverable for us also as internal audit members. Where we'll have to keep introducing new tools, keep evaluating new technologies, the way we can use for reducing the amount of manual monitoring or transaction testing that we do.
Sebastian, I just wanted to ask: is this all this internal audit reports for NBFC? Does it goes to the RBI also for their review purpose?
Yeah, in fact, let me tell you one thing, I'll just tell you this of our experience. The very first thing that the Reserve Bank does when they come, for inspection is they ask us one, for the internal audit reports of the last, say, 12, of the last, 12 months or, 4 quarters. The second important thing that they ask you for is all the various policies that have been approved at the board. And the third important thing that they ask is, of course, the statutory auditors' reports and all. But there's a lot of onus put on the internal audit report.
Okay.
And the whole idea now, I mean, when RBI comes now also, like, see, they have set, the risk framework. So very shortly, when they come also, they'll be, evaluating whether the risk management function has done their job, whether they have defined, theoretically, whether they define the framework, whether the framework is working, how effective it is, whether we are effectively challenging business. So that's where, RBI is currently.
And is there any minimum qualification would be requiring from a third party, the same as what we get for a forensic auditor? This all the uh, past experience, based on the past experience. Is there any some criteria for the auditors?
You're talking of an audit firm here, or are you referring to,
Or
say, uh, individual who wants to join the internal audit department?
no. The company, if
The
he
company.
wanted to mandate, the company wanted to mandate to a third party auditor. Okay,
Okay.
so does it minimum there is a requirement that the firm should have done this kind of the audits, or it is open?
No, I'll tell you. So here there are two aspects to it. Now with the RBI guidelines, we are expected to actually, set up our own internal audit department. We are supposed to adequately staff it with, adequate resources, having those technical expertise, be it in analytics, be it in, IT security, or whatever business related knowledge, having retail loans knowledge, or whichever business that the NBFC is involved in. They have very clearly mentioned that we can't outsource, the internal audit function. So basically, they want to put this full responsibility because no one knows the business better than internal employees only. So it's more skin in the game. Of course, they'll have to manage their independence and objectivity, but this is what it is. Nevertheless, I mean, depending on the scale of your operations and the complexity, there are some, of course, number of NBFCs which will represent to RBI, that given this geographical spread, it doesn't make sense for them, to deploy resources at all these small branches.
True. Makes sense. I think some hiccups have been happening. Hello, uh, hello, Sebastian. I think there is some internet connectivity issue is there. Hello, is I'm audible to everyone?
Yes, sir, you're audible to everyone, but Sebastian sir's screen is frozen. I think.
Sebastian, you're on mute. Hello.
Can somebody call him because looks
Yeah.
like his
I will call.
internet.
I will just call. Your internet connectivity is down. We cannot hear you, or we cannot see you, and you're also on mute. Uh, from when? That's what. So you're waiting, and your also camera is off. Your camera is also off, and you are also on mute. You can acha. If you can unmute. हाँ, Can you unmute yourself, Sebastian? Sebastian?
He's not connected.
That's what you said. You said.
He's come.
Here come. But still is on mute.
Hello.
Yeah, now he's on.
Yes.
Yeah.
Okay.
Yes.
Yeah, now we can hear you, Sebastian.
Yeah. Sorry, what happened? I don't know. I went on talking. I don't know where I left. Sorry, Bhavin, where I left.
Yeah. So here this next slide. Come to next
Yes.
slide. Yeah. This.
Yeah. No, I was saying I was answering you.
The answering with respect to the in-house internal audit, and now the
Right.
representation will be going into the RBI, since it would be
Oh,
requiring an expertise.
right. Yes. Okay.
Yeah.
Fine. I mean, I answered it, but I don't know where. Yeah, I
So
just
now
went
this
on.
slide. Yeah. The role of the senior.
Okay. Fine. Yeah. So I answered your question then. I don't know. I actually
Yes.
covered the.
You have
Oh,
answered. You have answered
okay. Done. Okay. Great. Sure. Yeah. So then, in terms of role of senior management, so here, though the board has been given, the onus of, ensuring that the risk-based audit is put in place by 31st March, the RBI also has, given certain set of responsibilities to the senior management, who are directly connected to the board, who will actually handle this entire transition, who would ensure that whatever change management needs to be done in terms of either identifying resources or be it in helping to get this internal audit function up and running. They will keep updating the progress to the board. Yeah. So yeah. So sorry, can you hear me? Yeah.
Yeah.
So yeah, so the senior management, yeah, their role here is, to totally to help assist us into audit function one in terms of recruitment and staffing them, in terms of helping to identify monitoring risks, and also their main job is to develop sufficient and effective internal controls to manage this risk. And not only that, in case there are any internal audit findings, their role is also to take the necessary action on this and place the closure reports or the actionables before the audit committee or the board. And what has also been put in here is that the senior management has to consolidate the various major risks that they face at the audit committee and the board. So they have to one consolidate whatever risks have been identified, what are the actionables they have taken, and keep updating this till the actionable, or rather till the mitigation measures are in place. Sorry, any questions?
So as of now, no. So do you wanted to say that open issues point? Do we also need to report it, but only to the in-house, not from the RBI side, correct?
Yes, so I'll just mention here, when there are open issues, I'll tell you what happens is if you see, the internal audit also is given this task of, reporting open issues which have not been reported. They are expected as per the guidelines to highlight any high or medium area risks, where there has been no action taken and the risk mitigation measures are not in place. I mean, it is in the interest of the internal audit, to highlight it. So, this needs to be highlighted. Of course, there's a very, what I would say here, there's always a thin line of balance that one needs to draw, as internal management, as internal auditor, who was part of the management, who's another employee in the company. Because whatever items you mentioned in your internal audit report will definitely be seen, at the Reserve Bank's inspection. So generally, whenever we have open items, we work very closely with the functional heads, and we give them a timeline within which they are to complete, the closure of that open item. because in case they don't close, then we are forced by our duty to report it, and reporting it, of course, and puts the onus back on management board, that this has not been closed. So it is imperative. I mean, so there is a balancing act that we as internal auditors need to do. I mean, we just can't keep reporting and documenting it. We need to work with the management first to get their see, because ultimately, as internal auditors, we are basically just another stakeholder. We are just doing the second level of checks for them on behalf of the board. So basically, we are all on the same side. We need to work with them on that. But nevertheless, if within reasonable time action is not taken, it's within our interest. It's in our interest that we report this.
Okay. Thanks, sir.
I'll just move over to the internal audit function, and I mean, these are very standard. These are actually the principles in which proper internal audit function needs to base itself. One is on the authority, stature, and independence, along with the resources. So basically, it is the standard thing where the head of internal auditor should have that kind of stature. He should be able to communicate with any staff member, or access anything he wants, even approach the board if needed, or approach any audit committee member. He should be able to carry out his assignments independently and properly. In terms of competence, yes, they are required to have the professional competence, knowledge, and experience. So that is like further to your question, Bhavin, where this is what is expected of the internal auditors, um, I mean even the employees.
So minimum rotation of the staff, if you can, so if
Yes.
the
Yes.
so that
Yes,
is the so if you are hiring an employee within your organization, so does it the same reporting structure that CEO it has to be appointed from that RBI authorities if you are hiring the head of internal audit for this? So does it approvals and everything has to be routed through RBI or only from a management present?
No, no, I'll come to that point. Yeah. So in the competence, the last other point is the guidelines very specifically mentions that the internal audit team should have resources who are experienced both in operations and accounting and information technology and security, data analytics, forensic investigation. Coming to your point, on this, your question on rotation of staff, there are two, three approaches here, that organizations have. Of course, now, putting a internal audit firm is like kind of ruled out that, yeah, you may use them, to do, say, a branch audit or, do the audit of, far off locations. But when it comes to hiring, what many organizations, what many NBFCs are doing is the head of internal audit, they are, looking out for in the open market. Nevertheless, after appointing such person, they would be required, to intimate the RBI. I'm sure, the RBI somewhere close to 31st December, or between 31st December to 31st March would start doing follow-ups with all the NBFCs to find out whether the appointment of the head of internal auditors happened. In fact, similarly, when I was appointed as CRO, that was post the May 2019 guidelines. There were a lot of follow-ups and a lot of mail reminders sent to the organization asking whether a CRO has been identified and to share the credentials. In terms of staff, yeah. So once the head of internal audit comes, then there would be the team that he would be or she would be setting up, and there would be various people required having the specialized knowledge in various fields, be it forensic investigation, data analytics, technology, operations, accounting. So there is always I mean, a lot of NBFCs are looking at it in this way that maybe they can give some people lateral movement within the company. Existing employees could be taken in certain cases where the companies can't afford to let go some resources to the internal audit team. Then yes, they may get such candidates from the open market. So this is what is happening at the moment here. But everything begins with the head of internal audit appointment.
Okay.
Sorry.
Yeah, somebody wanted to ask.
Yeah. Any questions? Okay.
Okay.
Yeah, sure. So here also, for the staff also, it's prescribed, that if you take someone from within the company, there should be a minimum period that you keep this person. This is basically, just to ensure that there is, some kind of objectivity and independence that this person has. Similarly, they believe, if you're appointing a head of internal audit, if he's not a career internal auditor, if you're just deputed someone within the organization only, given lateral movement, then, it should be for a reasonably long period, say for a period of about 3 years. The reporting line, there are just very similar to the risk officer, the chief risk officer. Here also, there are two modes possible. Either you report directly to the audit committee or the board, or there is a reporting done to the MD and CEO or, the whole-time director. But many organizations prefer, to have a direct reporting, to the committee boards or to the board directly. Because that demonstrates independence and objectivity on part of these critical functions like the head of internal audit and the CRO. But in case any organization decides to go with the MD or MD CEO and a full-time director, then in that case the reviewing authority will be the audit committee or the board, and in case of the performance appraisal, the board will then be the accepting authority there. And in all such cases, the board or the audit committee is expected to meet, with this head of internal audit or audit, once in a quarter. And these guys, I mean, whatever the head of internal audit, CRO, they're expected to be given no business targets and have no reporting with any business vertical. The whole idea of this is just to ensure that independence. Like even when you look at remuneration, the remuneration also has been kept separate from the financial performance of the company, or the policies also are not structured in a way which would compromise the internal audit person's independence and objectivity. So this is like a very critical requirement, which the RBI in its guideline has kind of reiterated at several parts. So it's very critical. Moving on, to the next, even if you see in the risk-based internal audit policy, that is required, they have touched upon this point, that we need to factor in the key attributes of independence, objectivity, ethics, and accountability, in the policy. Of course, this policy will have to be approved, by the board. It needs to, cover the objective, the authority, responsibility of this internal audit function. Very importantly, the roles and expectations of the management between the risk management team and the risk-based internal audit function should be demarcated very clearly. And given the size and nature of the business, we need to, and even considering the complexity of operations and the RBI policy is expected to be drafted and formulated. One important thing that which is where I'll touch upon a little with an example. They have mentioned that there is a maximum time beyond which even the low risk business activities and locations should be covered under, and they should not remain excluded from audit. This is one thing which I've seen a lot of internal audit firms err upon. I mean, even I've been part of internal audit firms in the past, and we have seen this happen. There are certain areas which the company coins as a low risk, and they would coin these things as low risk like almost for decades together. There are some smart employees or other rogue employees who see this, and they sometimes try to manipulate and try to benefit from this. One classic example I'll give from my internal audit experience. There was this company where somewhere way back in 2002, I was just a little before I qualified. We were doing the internal audit of this firm where this company was involved in of course it was a retail facing organization, so there were certain channel partners who brought in business, and there was a royalty points program which was started for them. And the interesting thing there was a lot of people saw this as a very low risk area where there are loyalty points given to consultants or people who, or other channel partners who bring in business, and no one paid too much attention to it. They said, okay, once it's 10,000 points will happen say in 6 months, 8 months, or a year. Then there would be some small, like a TV, or in some cases a fridge, or in some cases a gold coin, which would be given. And not many business functions, the CFO's office or even the internal function took too much interest in this. But somewhere there were some smart people who manipulated this. And how we got to know it is after a year or two, just when we were we had reached a particular point, there was a lot of business garnered from customers. There were a good 20, 30 channel partners who were felicitated. We just realized that out of these channel partners, when we thought let's run this program of felicitating them, let's go meet them with a bouquet of flowers, and let management go and do it. So we realized in one case where management went to meet these guys, it was a home setup. There was no office setup there, and it turned out to be the residence of one of the employees' uncles or something like that, a relative, a close relative. And we realized that that guy just created a code, or he put him as a channel partner there, and lodged all the referral or walk-in business there, and yeah, managed to get one a payout there as well as loyalty points, and get some things there. So this is what happens when you coin something as low risk and keep it out of your antennas. This is what happens. Sometimes there are rogue employees, or the people waiting for opportunities, rather, who look for opportunities like this and try to exploit it. So this is a very important point that I guess RBI considering these kind of X examples. This is one example I know, but there would be X examples which the RBI would have realized, and they have actually asked us in the policy to mention the maximum time between when the audit is done on one particular low risk activity. So the time duration between the two audits has to be defined here. Ideally, of course, we prescribe 1 year, but it all depends. The way business is rapidly changing, I mean, no amount of time is we can't say that 1 year is a reasonable time to audit. Sometimes after 6 months also the things change, like the way fintechs are coming, disrupting the NBFC space is phenomenal. So what we used to think about 6 months or maybe a year back, now going forward has completely radically changed. And lastly, the RBI policy you mentioned needs to be reviewed periodically. So generally, most NBFCs are taking about a year, to review their policies, which I guess is, reasonable. Unless you have something like a COVID which comes in, and there's a radical need, then you to look at your policy, look at the audit procedures, look at the risk assessment metrics, and rework things. Any
So
questions?
so do you have in your bucket, okay, what are the point parameters to be considered while framing the policy? The next
Yeah.
slide. Okay.
So this is what I mean. We need the purpose, objective, authority, responsibility. Need to demarcate, between risk and all. Need to cover the size, depending on the size, nature. Then the policy has to be drafted. We need to factor in the various, attributes. Put some time limits there. There should be a clause for renewing it periodically.
Okay.
Coming, yes, to the RBI plan, this is also a very important point. I mean, of course, it needs the approval of the audit committee and the board. But one critical thing that various auditors and even auditees, what we miss out is defining an audit universe. Very important it is, to define a proper audit universe. Sometimes this is what happens, in low risk areas. You'll define maybe all the functions, all the processes, but something which doesn't have significant, say, financial or material impact, will get missed out. And sometimes that is what proves to be the Achilles heel, for the organization. So, it's very important that when you start an audit assignment or audit plan, that you define the audit universe. You list down all the functions. Within the functions, you list down what are the various critical processes that need to be looked in. Try to assign some kind of a risk rating to it, which is high, medium, low risk. What is the likelihood of something going wrong, and whether that would be high, medium, low. Accordingly, formulate what the severity of that. Area would be, whether it should be high, medium, low, and accordingly, plan in your audit plan, like as to when you will at what periodicity you'll audit this aspect of the business or that, any particular aspect of the business. Another important thing here is reviewing this risk management framework. So as a internal audit person, you all should not take whatever the risk management, I'm saying it as a risk management person, but don't take it as sacrosanct. You'll need to independently assess it. You'll have to use some commonsensical approach there and see whether what is being said there makes sense. You'll have to see whether does this hold good even today. Maybe when the risk management framework was drawn up and categorizations were done, assessment was done there, something may have looked high, now it is somewhere in medium or something. So all these kind of aspects will need to be looked in when we get to this. The most important thing will be reviewing the risk framework, reviewing it, uh, looking at whether the risk categorizations, whether the priorities have been defined basis the both the magnitude and the trend and which the risk is going, whether it's consistent with that. I'll touch upon this in the next slide, yeah, in more detail, with an example and giving some uh, more graphical description of this. Yeah. Also, carrying on this risk assessment of the businesses, there is a risk assessment matrix, which will be drawn basis this. There's a risk, what I would call a risk score or a risk heat map, which accordingly gets created. And basis this heat map, then we realize, okay, this is high or very high risk, or even medium or reasonably medium risk, which need to form the crux of the audit plan. And we need to review these, or we need to audit these areas more frequently than the other aspects. Okay. And so here, when we do this, we have to ensure that when we do the risk assessment, it is done on an annual basis. And at the same time, again, this point has even been brought up in the guidelines under the risk-based internal audit plan, that there needs to be a maximum time beyond which the low-risk business activities will not remain excluded from audit. And there is also a clarification given in the guideline, that the internal audit will not only just restrict itself to business and the various functions, accounts, for example, IT, but it should even go on to audit risk management and compliance functions. Yeah. Yeah. This is actually the main part, and this is the most challenging part. Believe me, in your internal audit plan, if you do the risk-based internal audit plan, this is where you'll have to deploy most of your gray cells, where you'll have to use most of your I would say intellectual capacity. So one is identifying the various inherent risks that we have. So when we look at inherent risks, maybe I'll give it with examples, that will be more easy for you all, to understand. Actually, it's a little difficult, because, to even quantify, because I may give one example, that one example may be a high risk in one organization, but in another organization, it may be a medium risk. Okay. Or sometimes even on the time at which, that risk suddenly, comes up. If a risk pops up, say on a weekend, then say for example, a IT outage, say the systems or there is a big power outage, in the servers and the systems are not available. If this happens on a Sunday, then the impact is virtually low to, I mean, it may not even be medium. Yeah, so the impact will be hardly anything, but if it were to happen on a working day, say on a Monday or, somewhere in between, one of the working days during the peak time or the peak season of disbursements or things like that, then the impact will be enormous. And so even if the likelihood of this is low, but the impact would be enormous. So one example, depending on the timing, it has a different impact. One example you could have where there is one particular risk which you all may perceive low, but it will be very high. Say for let me give it with an example. Say there's a company which is into wholesale lending. There is a 5 crore, you know, account which has suddenly, gone delinquent. For a company having a 500 crore book, I mean, this is huge. This is almost like 1% of the book, so it will be huge. the impact will be very high, in case it goes southwards. Whereas if it goes, bad and they're not able to recover this money. But for a company, which has a balance sheet size, say of say 10,000 crores, I mean the impact will be significantly lower. So same thing, same amount, same quantum, but the impact is very different. So most important thing, when we look at a risk audit matrix, and that is what I'll cover in the next two slides. There is also a point that we need to basically when we are there is a basis that we need to give on which we are going to categorize something as a high impact, a low impact, or a medium impact. And even the likelihood, there would need to be certain criteria given. Now this is something that when you're drafting the policy, it is you have to take real life examples across functions when you go on to do it. So like for example, if you're getting say a customer complaint of a particular nature, or rather let's not talk about customer complaint, let's talk say of possibility of say a virus attack, with something which leads to loss or erasing of your data. Now if this so if you were to get say spam mail or some junk or phishing mails, say if you get one or two cases every quarter, it is not so alarming. But and this is what we saw, a lot of NBFC saw during the COVID times when there was remote working and a lockdown. We suddenly saw these numbers jump to significant, like almost 10 times or 20 times. So then we realized that the likelihood now from low has gone to almost a medium. So and the impact of course would remain more or less if a fraud is done during COVID or before COVID or during COVID, the impact in terms of monetary loss or loss of data would more or less be the same, but the likelihood had increased. And there were means, there were matrices like your SOC was throwing up how many such cases came up, or there were certain log alerts generated. So this is how you could actually correlate to this. So so these kind of instances, maybe you can in terms of impact, maybe you can set some benchmark, say anything where the financial impact would cross 5%, could be categorized as a high impact, and accordingly you could go on to categorize your medium and low impact accordingly. Likelihood also, you could give some means, either it could be percentage in terms of number of instances, or it could even be an absolute number of instances where we could categorize these. So this would differ function to function. From it could also possibly in times also, in different times it could differ. So today we are talking of something, but tomorrow as the scale of operations increases, or possibly the complexity changes, then that's the need, that's the reason why you need to do these reviews of your risk audit policy, sorry, your risk-based internal audit policy every year, because things are changing that. So yeah, so what I meant, yeah, so this is how you will actually evaluate your inherent risk. So you look at instances like this, say like let's take that example of say there's a power, there's an IT outage which renders you unable to cater your customers. Of course, the likelihood that will happen, I mean likelihood, many organizations put it on maybe the y-axis and impact is put, but it's quite interchangeable, because the output will remain the same and the heat map will look the way it is. So if likelihood of something like this happening, say, is a low, but the impact that it happens say on a working day would be high. So then this case, the inherent risk here is categorized as a medium or a moderate. Excuse me. Yeah, it's categorized as a medium or moderate in this case. Let's take some other example. Let's take the example of say, you can say in these times, say liquidity is a concern. The likelihood of there being a say the equity market crashes, for example, and there is possibility that the debt markets liquidity will be very difficult to get. So the likelihood here, say, is a medium. The impact depending again on the organization, depending on its the borrowing mix, it would be lie between a high medium. So if it's a AAA customer, maybe the impact would be medium, but if you have, say, a double A or a lower kind of a company, and lower rated company, the impact would be high. So again, this all matters in these kind of cases. Maybe I'll just take a minute here, just in case you all have any questions. I know this is quite something to grasp, especially if it's new to you. We have been doing this for 2 years, so we have a fair idea of this. But just in case any of the participants, have any questions around this.
Hello.
Yeah, Krishna.
Sir, do we need to have only qualitative factor or we can use only quantitative factor or the combination of the both at the one?
Right.
And the
Right.
second one is, sir, follow-up question on that only. So let's
Sure.
suppose we are doing the commercial vehicle business. Okay, so while doing this assessment, I need to divide entire loan into different life cycle like sourcing, underwriting, operation, collection, or I need to do the risk assessment for commercial vehicle business itself. How I can categorize that into low, medium, and high?
Okay, right. No, very, very good question you took, qualitative and quantitative. So this is one challenge, that all organizations, even ours, face this at the start. So there are certain, if you see risks, not all risks are quantifiable. There are credit risks, market risks, operational risks, which are very easy to, quantify. These are also easy to, identify, measure, and stuff like that. Challenges, in certain other risks, like reputation risk, for example, you never know, like, what, so financial impact, maybe little, but the amount of, non-financial impact it could have could be, huge. So there, you'll have to, put in certain, qualitative factors. Thanks actually for bringing this up because a number of your risks also depend on qualitative factors here. Yeah, that's one. Coming to your next point, on your from the commercial vehicle business. Sorry, which organization you're from?
So I am from Industrial Capital. Okay, so we have the
Oh,
different businesses. So
okay,
let's
right.
suppose I need to do a risk assessment of that. So we have commercial vehicle, SME loan, and a corporate lending.
Fine.
Okay, so for each loan have a different loan life cycle. So how I need to do a assessment for that? So that was my question.
Right. Yeah. So again, this depends on which risks are you assessing. If you're so from your question, I get it that you're looking more at the credit risk of it, right? Credit collection risk maybe of it. So
Right,
if you're
right. So,
yeah, so if you're looking, sorry, yeah. So if you're looking at the credit risk aspect of it, then definitely, the risk parameters will be very different in all three businesses. There are different life cycles. Uh, yeah, that's one thing. The second is also the segment of customers that you're tackling, and their behaviors also will vary a lot. So I would always suggest, that this should be done in a, it should be looked business wise. You can't, use a one cap fits all kind of approach. You have to be looked at each separate business at a, sorry, at a business vertical level. You have to, work this out separate.
okay, sir. Okay, sir. Thank you, sir.
Sure. Thank you.
So yesterday also, finance minister has announcements of bad loans. So can this be also consideration during the credit collection? Because the same was moratorium what the earlier in COVID one part, the government has emphasizes and this how the credit risk was reduced is what I understand. But yesterday, what the finance minister has said for the bad loan also they are going into consideration for the guarantee part.
Right.
Can this
Uh,
be into consideration
right.
during a risk assessment or a credit collection? What uh, this colleague was saying.
Right. So, maybe I'll take you, during the COVID period, what our organization faced. So during
Yeah.
COVID also, yeah, I mean, it was a very big event, and we had to really get back to the drawing board and actually do a lot of stress testing, see what kind of impact it would have on, various businesses, various facets of our I would say liquidity risk, credit risk, and overall profitability. So when we did all these exercises, we realized, and this was way before moratorium was announced, way before restructuring, after 2 rounds of moratorium was announced, we were very sure, that there are a lot of customers who are not affected by COVID, who would be having proper jobs, or, their rate cut would be minuscule, but who would, in the name of COVID, be, displaying very different repayment behavior, which is what we saw, so this is what happened. So moment COVID happened, we realized it, and we had put that as a collection and repayment risk that we feared. So so exactly when an event like this, we had to actually reassess our the impact ratings and the likelihood scores and all. So that's where there was a small realignment seen in the risk assessment at that point of time. So even with all these guarantee plans and all this, when people realize that the government is going to either underwrite or back up their or guarantee the payment of those loans, so generally the tendency of these guys is to wait for such announcements, and they would go on to either hold up such payments. Sometimes this also happens at the cost of their CIBIL records, that this happens. So yes, all these things definitely have an impact. Government can answer your question. Definitely needs an impact. In fact, any such event, any such major event that happens, so first thing that you need to see is, which functions it actually affects, and you should actually ask these guys to go to the drawing board to start, actually, their whole risk assessment exercise once again, and to see whether there's been, a change, or there's been, some realignment of, the various, what I would say, risk categorizations. So that's very essential. Yeah.
Okay, thanks.
Sure. Yeah, so going to the next, I'm looking now at this grid, which is on the right-hand side. So this is basically the Auditorius Matrix, which is a derivation from your inherent risk, from that particular risk matrix. So this looks at the inherent risk on one side, and it looks at what are your control risks, what are there. So just to give an example of this, say like the example that I gave of a power outage, which lies in say a high impact and a low likelihood. So the inherent risk here, medium or moderate. So if you'll be looking in the second, grade, you'll be looking at the middle, column, the moderate column. So for example, there's a power outage and stuff like this. Then, what are the controls we have in place? So yeah, company which is huge into IT investments and technological, uh, what I would say, investments and outlays. Now these guys, they would spend a lot on say SOCs. They would spend a lot on having proper, DR sites, disaster recovery sites, and things like that, or even having a backup server and things. So here, possibly, with very strong controls, their overall control risk will be low. Okay, so they'll end up, in this. I don't know how whether you can see the cursor moving. I'm not sure if that's there, but they will, appear somewhere, in this green box, in the middle here. I'm looking at the right-hand grid right there. It will look so moderate in terms of inherent risk, and low control risk because they have very strong, mitigations in place. Similarly, if something like this were to happen to a very small, company, say a company which is just about 100 crores or 200 crores big, who doesn't, have much of IT budget, or who don't have even sufficient IT resources, for them something like this would be high. For them possibly they would be on this red box in the middle row. High. I don't know if you can see my cursor on that box. So for them it will be high. So things like that. So now you understood, right? The same scenario, two organizations, two particular scenarios. You have one which gets overall the risk of material misstatement (RRM) works out to high in one case, it works out to low in the other case. So if you see, that is precisely the reason, when you do a internal audit plan, you should look at these. You should look at these few scenarios. There are 6 scenarios totally. If you see, I'm looking now at the inherent risk, at that particular grade. If you look at the boxes which are ticked in, say, yellow and red, so these 6 boxes actually, if you see, are your main what you call areas of where your focus should be. Your audit plan should actually prioritize these areas first. uh, Sometimes some people would say, okay, but my main risk, my residual risk lies in these 6 boxes this side. But you saw in this one example that I gave, there are 2 possibilities. If you have very strong controls, it will come in low. If you have weak controls or no controls, it will go in high. So you can say that one thing. I mean, though it is a medium or a moderate risk, it has had 2 separate what I would call it outcomes. So that's why it's very important, when you draw up your risk plan, look at the inherent risks, because the inherent risk is ultimately the major risk that your company faces. Your controls and all fine, they may be strong today, they may become irrelevant or ineffective, say 6 months later or a year later. So there is always a very urgent need that you need, to look at control risk. So always when you drop your plan, look at your inherent risks, drop your plan, drop your prioritizing strategies, basis your inherent risks, not the other way around. Yeah. Any questions, please?
So Krishna here again.
Yeah.
Go on.
The frequency of the audit will be based on the your residual risks, or we need to be based on the inherent risks. So audit plan, that whether we need to do a audit a year or after 2 years or the 3 years, that will be based on the my inherent risks or based on the residual risks.
No, always on your inherent risk. I always suggest that you do it on inherent risk, because controls. Okay, fine. It is controls which will determine ultimately what is your residual risk, whether it goes into high or it goes into low. But most importantly, it is your and most important, it is your controls. The efficacy of this controls, it never remains the same. See, just like viruses, just look at coronavirus only, for example. Okay, we thought when we went into lockdown, we thought in 40 days we would be out from there. But then we came out with so many variants came up, and we had second wave and things like that happening. So similarly, I mean, when you same thing, even with your computer viruses, you come up with a virus, you come up with an antivirus, sorry, to counter this virus. The hackers, or these all these malafide elements, then they try to decode that that antivirus that you come up with, and come with a even stronger virus, which will actually circumvent that particular antivirus program. So it is very essential that just as these hackers, they keep on upgrading their viruses, the antiviruses need to be upgraded. Similarly, even controls, though you put very robust controls in place, it will never stay put. You will necessarily need to keep reviewing, revising these controls. So I would always say, base all your plans, your strategies around inherent risks, not the other way around.
Okay, thank you, sir.
Yeah. Also, when it comes to 1 year, 1 year we believe is a very reasonable time, to do this. Uh, but there are certain businesses, like for example, retail loan businesses, business, if you see HFCs, home loan finance companies, their cycle lasts for, say, anything between 10 to 15 years, maybe longer. Education loans, for example, is around 7 to 10 years. You have personal loans, which is anything between 3 to 5 years. So depending on the cycles, also sometimes these businesses undergo radical change, or you tend to see trends, basis when you do data analytics. So generally, if your business is a very fast-moving business, say it is something like a skill financing, where the overall tenure is just about 18 months to, say, 2 years maybe. In that case, maybe you may feel that 1 year is too long a period, and your business and business dynamics have been changing much faster, much rapidly. In that case, you may feel like kind of doing this review even faster, say 6 months. Just for example. Yeah, and nevertheless, I mean, sometimes also, like when COVID happened, we had just completed risk review and everything. But when COVID happened, we were about a month into COVID. We realized that whatever assessment was done there has changed now. That India shining story, which was just we had just formally signed up on, has suddenly changed now. The parameters have changed. There's a very different economic outlook we are looking at. There's a very different global outlook we are looking at. And I mean, it's been like almost what 18 months since then, and still the outlook is pretty much uncertain. Yes. So if this continues longer, then maybe again you'll have to review. So I mean, that 1 year can't be kept sacrosanct, and especially in an environment like this, it will change and improve more. Yes, sir. I hope I answered the question.
Yes, sir.
Sure.
Yes, sir. Thank you, sir.
No, but I really, I mean, appreciate questions. I mean, this is not like a presentation where I talk and go. I really appreciate questions coming where I can throw some light there. So please don't feel, don't hesitate, don't feel hesitant to ask any questions. Yeah.
Hello, sir.
Yeah. Hello.
Yeah, this is Nikita here. Actually, I
Hello.
wanted to ask if we are like for NBFC, we are doing first time audit for any product. Like that product was in existence for long ago, but we are doing the audit for first time since inception. So how we cover the audit period means shall we cover 1 year from now, or we have to cover since inception?
No, I mean, ideally, look at your, terms of engagement. It would be given for, say this financial year. So, cover it for the period of review. That's how, you'll have to do it. But nevertheless, I mean, when you form your audit plan, don't, just start with, this year's data. Try to look into 3, 4 years data. Try to, get summarize, some intelligence of your own, there around that. So, I mean, of late, we see a lot of, lot of wealth of knowledge that you get, by looking at analytics. Sometimes, like for
Yeah.
example, I've been working in this company. We have been, looking at data for last 14 years. We have been doing this business. But when we look at data, say after 14 years, we suddenly see trends. When we try to break these trends, say into smaller periods, say we look at the last 3 years, we look at, say between 4 years to 6 years back, or 7 years to 10 years back, you get completely different stories, completely different perspectives, and this is very interesting. So, of course, though when you do your audit, you should do the review, say for that period of for whatever period of review your letter of engagement covers. But nothing should stop you from asking for previous data and trying to get better insights into the product. Because as I said, I mean, I don't know what business you're referring to, but it all depends on the life cycle of that product. So uh, uh, if the life cycle of the product says 3 to 5 years, then maybe you'll have to look at say 2 cycles, just to understand a little better of the product.
Correct. Correct.
I mean,
Okay.
this is basically for, yeah, this is just basically for your insights. I'm very sure, as per terms of engagement, yeah, if you look at current year's thing, but then, it'll just be your, if you want to have a control over, what you're auditing, it is always better to have a, to take a broader horizon, to review.
Okay. Okay. Thank you.
Sure, thank you. Yeah, any other questions, please?
Yes, sir. I have a question.
Sure, sure.
Am I audible? Yeah.
Yeah,
So
sure.
can we have a co-sourced internal audit team, like an external internal auditor as well as the in-house audit? Is that there, or do we have to have an internal in-house team only?
So if you see the guidelines, so if you see the guidelines, clearly mention, that there is a there is a head of internal audit which has to be appointed. Along with that head of internal audit, there is he has to be or she has to be, adequately staffed with resources having, the relevant professional competence. So with all of this, all of these things, it makes it very clear that, what they're looking at is an in-house internal audit. I mean, in certain interactions, we have realized that, when we have the CRO seminars with the Reserve Bank and all, in the passing, they have mentioned, that many companies give this particular, what you call, defense, that, okay, aisa problem ho raha tha, ya aisa fraud ho raha tha, but we didn't know anything because the internal auditors didn't catch it. So I mean, everyone knows that an external firm, which does the internal audit, they have just what about a 20-day horizon, to do the planning, to do the execution, reporting, and then the follow-up. Just about 20 days in a quarter. So that is not sufficient to get enough insights. So the whole idea of this circular is, yes, definitely to get insights. They are saying we can't outsource this function. It's clearly mentioned there, but nothing could stop us from, using experts. Like for example, as I mentioned, us like for a 5,000 crore company, it may not be feasible who has, say for example, 150 or 200 branches. It will not be feasible for them, to have 50 or say 35, 40 resources, so field resources who can, visit those outreach branches and, do an internal audit. So for those cases, maybe you will have to necessarily deploy internal audit firms. Or sometimes, I mean, a lot of NBFCs also, the smaller ones, definitely, would be feeling that, this is a little bit too onerous for them. Like, even the deposit taking NBFCs, like, irrespective of, whether they have, say, a asset base of 50,000 crores or 500 crores, these guys would, need to, still comply with these guidelines, and it may not be, economically feasible for them. In these cases, definitely, I'm sure the board also will take their boards, will take an informed decision of, coupling or rather, having a external firm, to do internal audit along with these guys, along with the internal team, as such.
Okay. Okay. Thank you, sir.
Sure. Thank you. Yeah. Any questions, please? Okay. I'll just quickly move then. And just quickly move if you have followed this. In fact, this slide has been the toughest thing. It looks very simple when you discuss it and all, but believe me, when you put it into practice, this is where most of your time will go. The initial, I guess, it will take a good 3-6 months only, for NBFCs of a reasonable scale, to actually review and assess this. I'll move to the next slide in the responsibilities and other general expectations. Of course, this is no rocket science. This is all things which have been covered in this circular which I've just put in here for in a couple of slides. So one is of course these are all very standard. It's just for the sake of making things very amply clear, because I guess regulators also realize that till you don't put things in text, in absolute terms, people won't comply with, or want to use the proper what I would say, they wouldn't take the efforts to go beyond what is given in the text. So that's why they have put in. But I'm sure like as part of your normal audits, this is all what you are doing. So of course the inter audit will be based on policies and procedures which are approved by the board or the audit committee. There's a talk here of focusing on material risk areas and prioritizing your audit work accordingly. The risk assessment metrics here, I mean, what I mentioned in the earlier slide, of evaluating both assessing your inherent business risk and looking at the control risks that come along with it. So this risk audit metrics will then bases the magnitude and frequency of your risks. Like there are those 6 areas you all would have seen in the previous slide. Here where yeah, in this particular slide, if you look at your grid, which is on the left hand side, on your left hand side, you see the yellow and you see the red parts. So that is like clearly what RBI has said need to be prioritized and given there needs to be special prioritization over these areas. So they have called it the high frequency and uh, high impact areas, and the high impact and medium frequency, low impact. Sorry, the high impact and the low frequency areas. Then again, medium impact and high likelihood, medium impact and medium likelihood, and lastly the low impact cases with high um, you know with high frequency. These have been categorized as your most what I would say, the ones with the highest magnitude and frequency, which need greater attention by the internal audit team. Of course, Krishna had already raised this point on quantitative and qualitative. So yeah, qualitative, you have all your other overall governance and your reputation risks and controls, which can't generally be quantified, but your credit risk, market risk, and operational risk, these are risks which we can quantify. Also, which I mentioned also, when we go to our risk-based internal audit policy, we have to form the basis for determining one, the risk level, and the inherent and control risks, which we should very clearly specify in our. We should clearly spell it out in our policy. And of course, this is a very uh, nominal point, independent risk assessment which needs to be done. So as I mentioned, you can't take the risk management framework, for granted. I mean, you all will have to independently challenge it, see whether, use a common sensical approach, see whether, that actually makes sense. Does that stand the test of time? Possibly it was right maybe 3 months back, 6 months back, but now it doesn't stand good, so all this needs to be looked into. Yeah, and lastly, of course, this is the last slide here we have. So the risk assessment methodology should include, your internal audit reports, your industry trends, environmental factors, business volume, the complexity, statutory auditors reports. So all these things would, go on to, determine what methodology we use. There should be proper awareness of the internal audit team, on what are the new products, changes in the product lines, accounting practices, policies. Most importantly, is you'll, will uh, require an MIS system, a very good MIS system, which will give you real-time data. So that is one thing, which will actually help a risk-based internal audit. I'll tell you what happens, generally, this is one challenge I've faced, over years, and which has improved over, recent times. Earlier, we used to get, data with delay. Now, of course, thanks to, the advancement of technology, all this has been made available more real time, unlike, how it was in, days of the past, a couple of decades ago. But this is something, which is very critical, getting proper MIs, which will help you all say, take out exception reports and understand, various, I would say, facets of the business. Like generally, I'll tell you what generally I do, to look at risk areas is, supposing we are talking of a particular MIS, say we look at a disbursement MIS. I will look at, say we have certain criteria for security, secured cases, unsecured cases. So I'll look at all the exceptional cases, say all the low value cases, which are where security has been taken, and I'll look at some of the high value cases. I'm just giving examples where no security has been taken. So high cases, high value cases with no security, yes, that is risky. Even the low ticket value cases, where there is security, means that there is some concern over the profile, over repayment capacity, and definitely, would need to look into it. Or probably there are certain FIR norms we have, or certain income, related norms, or income to installment ratios that we have. So I will look for aberrations around this. You say that okay, that this is a particular limit that you're given, for say FIR limit as per your policies, say some X amount. You will try to look in these MISs whether there have been any cases approved with FIRs higher than that, significantly higher than that. Or if you're looking at say secured cases, LTVs, exceeding some particular percentage, where so we look at things in this particular way. This also gives a lot of insights. So exception reporting also is very interesting in that way. It throws a lot of uh, I would say insights. When you go ahead to do this. Also, Coming to the third point, audit to be based on specific assignment. So when we plan, of course, it should be the assignment should have a very defined, scope, objectives, timelines, the resource allocations, and plan should be, very clear. And this also has been brought up in this circular, that see, I guess internal audit has been a little neglected until now, and the whole idea of RBI is to strengthen governance to ensure that internal audit very stringently evaluates business. Of course, there needs to be there's a tight rope walk that we as internal auditors need to do. On one side, we exist, or rather, all control functions exist because there is a business. So, I mean, the customer remaining at the center, we need to see how we can balance all the other risks, how we can, ensure that businesses, continue to happen with, in all earnest, and there is, a complete overview, that we as auditors have, while not ensuring that customer or rather the business is not uh, being impaired with our work or with our assignment. Yeah, any questions? Okay. uh, Moving to the next point, on the contents of the audit report. Of course, this is also, I mean, it has been elaborated in various standards also, that there needs to be proper analysis, evaluation. We need to, bring out very credible, reliable, relevant, information to support all our observation conclusions. And not only that, we need to even give appropriate recommendations and then follow up for the with these recommendations. See that the whatever the mitigation plan has been put in place, and the necessary action has been taken. Uh, Coming back here, so I again, it's not to be outsourced. Wherever required, yes, we can hire people on contractual basis, but of course, this is subject to the audit committee and the board's approval. And this is one point which we got in the guidelines, where the RBI has prescribed that a system is put in place to monitor compliance of observations, to report status of compliance to the board and the audit committee. So there is always this is what the voice of RBI has been, suddenly to adopt technology, to use systems, to reduce our dependence on Excel, rather than doing computations and calculation in Excel, get systems to calculate this. The whole idea of this is to ensure that there are no omissions by any chance, there are no misstatements, which ultimately will affect regulatory submissions. And lastly, I mean, this was discussed at the start also. It's very important, Bhavan. Bhavan had raised this point. It's very important there that in case there are any open items, especially if they're high, medium risk, that they're flagged off, to the audit committee or the board. But of course, here we have to first act, like proper employees. Ultimately, these guys, ultimately, we are all on the same side of the company. So somewhere, we have to actually see that, when we give the business teams, a particular observation, that, that we follow up with them, ensure that it is closed. In case there is a need that we get, the senior management's buy-in there, we get the senior management to support them with whatever IT budget they may require, or whatever IT, intermediation they may require. Of course, if there is a reasonable time which has lapsed, say a quarter or a couple of quarters where this action has not been taken, then it becomes imperative, and it's very essential that we as internal audit, then flag this off to the audit committee. Of course, when it gets flagged off to the audit committee in our report, then there are various stakeholders which will read it and act upon it. So it's always in the interest, of the organization as a whole, that we work together as a team and get these guys to complete this off. I'm talking as an internal auditor. For an external internal audit firm, it's a different thing. And there is one point, which we noticed, I mean, there's been a lot of talk around IS audit, IT, security, and all, going on with COVID times. There is a very specific mention, here, that we need to have like an in-house person, having necessary expertise in technology and IT security. So this is something, that that's just because most of audits have always been, I believe, substantive testing and maybe balance sheet audits in certain cases. But somewhere I feel this approach now, needs to even focus a little on, a system-based approach, where we, kind of evaluate systems more stringently. And this is, something which will, actually help the management get better assurance, that controls are in place and things are going to get properly addressed. So whatever critical findings and process lapses are noticed, need to get reported then to the IIT committee. Yeah. So with this, I guess I've covered most of the salient features of these guidelines and tried to address. In case you all have any questions, yeah, please. I'd be more than happy to take them.
Hi, sir. About the quality assurance program, they are asking in a circular. So how
Yes,
we
right.
can ensure about compliance of that part in our audit?
Right. So the quality assurance, of course, this is for the senior management to deploy and for the board and audit committee to actually subject you all to. So basically, there will be a lot of things where so generally I'll tell you what we do. There is a questionnaire we prepare. We prepare questionnaires on the feedback of the internal auditor. So we look at various aspects of the internal audit. Like what do they, like what areas do they cover? What are the material observations they have done? Whether it has resulted in cost savings for us, okay, or whether they have identified or given certain business advices which has benefited the business. Things like whether so cost of audit also has been something very critically that we keep reviewing. So how we ensure that we use technology to base most of our audit conclusions on whatever analytical procedures and techniques that we deploy, things like that. So it is when we look at a quality assurance program, we look at a lot of aspects like these. I mean, there are still more than this, but quick ones which I could very quickly cover are these points. So basis this, we do a scoring for the auditor. It goes to the audit committee, who then give their comments on it, and they go ahead to then do the performance appraisal of the internal audit function.
How sure that need to be documented in the policy, that risk-based internal policy, or it is a separate policy by the board?
No, this is not a separate policy of the board, but there is definitely a need to, as part of the policy, there is a review we had to do. This again, I mean, it's always, I always believe, though it's not mentioned in the guideline, I always believe that it's uh, that effective communication or transparent communication is the key. So if these guys are going to be evaluated on the basis of all this, and this is what the objective of the organization is, it is no harm in I mean bringing it out and informing them that these are the parameters on which these are some of the parameters on which they will be apprised. So so personally that is what my view is.
Thank you, sir.
Sorry, any questions, Bhavin?
No, no,
I thought you were asking something.
no, no. I was just asking, is there any questions from the participants? Rita, Nikita, Krishna, Pali. Is there any questions? Okay. Thank you
Just
so
one.
much, sir. Yeah, thank you.
Just one thing, I mean,
So,
all the participants, I'll just tell you a very small thing. Is we learn a lot, by asking questions. So never, yeah, so never hold back, your questions. You may feel that okay, maybe your diction is not clear. Yeah, this is, maybe you may not get the words clear, but nothing should stop you from learning. You should have the inquisitiveness of a child. Any questions. Will only help towards your learning. This study group, is actually meant for that. So you should never desist from asking questions. Yeah, in case you all have any questions, please. We still have some time. That's all.
No, no. Okay, sir. Thank you very much, sir. I would request Pareen to say thanking you note. Farin? Farin?
Hello. Yes.
Yeah, if you can give a voting
Good.
time.
Good evening to everyone. Once a great man said, feeling thankfulness and not expressing it is like wrapping a present and not giving it. I deem it a great honor and privilege to provide my vote of thanks on this fourth virtual meeting of our internal audit study group. First and foremost, I thank today's learning faculty, Sebastian Fernandez, who, despite his busy schedule, has found a time to deliver this lecture on this risk-based internal audit for NBFC. Thanking you very much, sir, for your detailed and very informative session on this internal audit for NBFC. We hope we get an opportunity to hear you again and again from you, sir.
Fine.
Thank you.
Yes, thank you, Parin. Thank you for your kind words.
Thank you,
And
everyone.
you all also have been a very good audience. I really appreciated the questions you all asked. Nothing should, ever stop you all from, having a nice, what I would say, frank and, open discussion like this. I mean, this is a small study circle group, so a small study group, we should, try to learn from each other's experiences, what I wanted to say.
Thank you very much. I just wanted to introduce for our next session. It is on 16th October and it would be on the enterprise risk management. And the speaker would be Haresh Shah. He is also CEO from Institute of Risk Management. So I request you to kindly block your calendars on 16th of October. Reminders and everything will be sent to you on your WhatsApp group. Thank you very much, everyone, for your participation. Great. Thank you, sir. Thank you, Sebastian.
Yeah, thanks,
Thank you,
Norman.
everyone.
Thank you.
Thanks. Thanks, Parin. Thanks, Parin. Nice vote of thanks.
This conference will now be recorded.